Hello, everybody. Welcome to Talk About Houses. I'm Todd.
I'm Juana.
So we found out some data today that is that's going to blow you away. When we first heard it, it blew us away. It's the percentage of homes in the U.S. owned free and clear,
Right.
meaning that they do not have a mortgage on them.
So this is super exciting because I am not a huge fan of debt, and so I am very proud of anybody who's got their home paid off and is not in debt. So here we go. Drum roll, please.
Okay. According to the Census Bureau, and this is, remember, this data lags a little bit. This was basically 2020 data 2 years ago. Nearly 40% of homes in the U.S. are free and clear of a mortgage. What is amazing about this is that 10 years ago in 2010, it was only 30%. It's going up. Now, this is incredibly important because this doesn't mean that 40% of of all the homes, they only have 40% equity. This means that 40% of all the homes don't have mortgage at all on them. And then we already know that 90% of all the homes bought in the last 2 years were put at least 20% down.
Right.
So this is a trend. More money coming in the stock market. Now, back when the stock market crashed last time, 2006, this was even worse. Very few homes. It was way under 30% of homes. Probably 20 to 25% of homes were free and clear. But the rest, it was like a barbell. You had these homes over here on one side, free and clear. And then you had all these homes over here that was this huge number with 100% plus financing.
Right.
Right? And we actually have the opposite today. We have is almost no homes over here at 100%. And then everything's over here beyond the 50%, all the way to free and clear. Like 40%, that's a huge number.
Right. And then keep in mind that over the last 2 years, we've had a tremendous number of homes, relatively speaking, purchased cash. And they've been purchased cash by people who are occupying those homes, by investors, and by, of course, institutional investors that we've kind of been beating to death for a while. So we're looking at somewhere around 27% of homes over the last couple of years have been purchased cash. So if in 2020, 40% of the market was free and clear, today we have to, assume that a number greater than 40% is free and clear.
Okay, so if you do the math, 27% of the homes purchased every year or purchased cash by investors, usually by investors, and the housing market turns every 10 years, and then you look all the way out so we're already over 40%, and then if you look out 8 more years, and if that trend continues, we're over 50%. That means over half the houses in the U.S. are owned free and clear.
In about 10 years.
In about 10 years. What this means is there's almost no chance that what happens in the mortgage market could negatively affect real estate because it becomes a small piece of the market.
Right.
Like most people don't, only 60% of homes have a mortgage on them. But remember, some of those mortgages are super low rates.
Right. So not only are they at low rates, they've got low balances, high equity. Most people who have purchased homes in the last 10, 12 years have had to put money down, not just a little bit, but somewhere around 20%. So they've got equity. They've got equity both because they put money down on their loan when they purchase the property, and they've got equity through appreciation.
Yeah, I think this is the best news I have probably ever heard about the real estate market.
It is, and you have to remember that all these people who don't owe anything on these homes, they're providing a lot of support for home values, right? Because they're not sensitive to what's happening in the economy as far as interest rates. They're not necessarily very sensitive to what's happening in the economy as far as jobs, because there's no debt against these properties.
And because there's no debt, then most of these people, one or two things are happening. They either live in them debt-free, okay, which is great, or it's one of their investment properties. Because we don't know the breakout. We can probably find out the percentage breakdown, but chances are, if somebody owns a personal residence and a rental house, and one of them's paid off, a lot of times it's a rental house because the rental house was the first house they bought. We'll do a video about this. This is fascinating because this is what a lot of people do. They buy the first house, starter house. It's usually pretty inexpensive, and they live in it for an X period amount of time. And then what they do is they don't sell it. They keep it as a rental. And then they go buy a bigger house for whatever reason, right? It's usually demographic. They get a little older, they have kids, they need more house. And they have more income and everything like that. But then they rent out the smaller house and keep it as an investment. And that gets paid off first because it's a lower loan. And if they bought it a long time ago, it was at a higher rate. Because if you look at mortgage interest rates, over time they've done this. They've just gone down. So anyone who bought a house, investment house in like the 90s was paying probably anywhere from 8 to 13%. And then today they're paying a lot less. So there was more incentive to pay off that super high rate, or they refied at some point to get the payment down.
Right. Because remember, people are very good about watching their payments. And so as the rates go down, people will generally refinance their property. It's not unusual over the life of a loan to refinance a property multiple times.
Yeah, I think so. Having the housing market backed by this much home ownership is huge. It's just more data. It's another data point for that. You can't use whatever model you used 20 or 30 years ago to value what's going to happen with real estate changes when so many people own their house free and clear. And these people that own the house free and clear aren't going to run out and get loans on them, because this number grows every year. This has been a growing number. Like I said, it was 30% in 2010. It's almost 40%. It was almost 40% in 2020, but it's probably over 40% now because 27% of all the houses purchased in the last 2 years were by Wall Street. They were purchased fully cash.
Right.
18% were Wall Street, and then the other 9% were just purchased by people like all of us. Not unless you're a hedge fund guy watching this, then we bought it, the other 9% cash.
Right. And if you're a hedge fund guy watching this, hey, reach out to us. We'd love to go ahead and have a chat with you because we want to learn what's going on in your world.
Yeah, we want to know is we're gonna do a whole video on this. But what are you guys gonna do once you get 1 million houses that you own? Because right now I think Wall Street owns about 500,000 houses in the U.S. Like, what's the plan? And then we won't disclose who you are. We'll just say, hey, we talked to a hedge fund guy and this is what they're talking about maybe doing with the house. We think we have an idea. We believe a long time ago we talked about this. I got to find the video. It's on the blog. We have 800 videos. A special prize if one of you could go find it back and find the video where I talked about this. I think it was a video I did by myself, but it may have been a video I did with Juana. It was probably done around 2010 or 11. It might have even been, it was probably done 2010. But what I said in the video is that I'm surprised there are not companies out there just trying to buy all these houses up in huge blocks, just buy as many as they can, so that in the future they can package and sell hundreds of thousands of homes like to other banks and entities. They can use these as trade collateral, because there's never been a way to do that. And I think that would be a huge thing, especially because Warren Buffett once said, if I could write a check and buy 200,000 residential homes in the US, I would do it today. But I can't do that because you have to buy 200,000 homes one at a time. But he says, I can do it. And we all know Warren Buffett's pretty good at kind of guessing what's going to happen. And I think that spurred a lot of people into investing in real estate. Well,
and I think that sort of talk spurred Fannie Mae and Freddie Mac into packaging properties and selling them in non-contiguous geographic area property packages that did go out to investors. They started doing that in about 2010. So by 2012, they were pretty much out of properties, and that's how they got rid of a lot of properties. I thought it was super interesting because I would see these packages, and they were packages of $50 million minimum. So of course that leaves regular investors out, right? It makes it very easy for somebody like Warren Buffett, but makes it impossible for individual investors like us. And so what they were doing is they were taking, a couple properties in Indiana, some in Georgia, some in Nevada, some in Nebraska, all over the country. And there didn't seem to be a whole lot of rhyme or reason how they were selecting these properties and packaging them together. And then that's what they were selling them. And it worked out really well for the government, but it also, I think, taught these investors who picked up these properties, because of course they were selling them at a discount. The discount was significant at the time.
Yeah.
If I remember correctly, they were selling them for about somewhere around 60 cents on the dollar. So they were doing just this booming business because now they didn't have to deal with, of course, real estate agents. They didn't have to deal with individual buyers and the financing and all the rigmarole that goes with that. They also did not have to do all the repairs because the properties were as is. And that worked out really well, I think, for everybody. But what it did is it created this experience for BlackRock and other institutions who went ahead and bought these packages. Yeah. And they looked at this and they said, hey, you know what? We can keep doing this. And we've seen a lot of that over the years. Of course, that they are packaging these. And we're seeing, just recently we saw that there was a hedge fund that went ahead and packaged a bunch of properties and sold them off to another company without these properties ever hitting the MLS.
17,000.
See, that's
for $6 billion.
Yeah. So that's a nice big package. So 17,000 properties, billions of dollars. Of course, we can't go ahead and
I'm short this. I don't have $6 billion this month. No. I had it last month, but I blew it at the casino.
There you go.
On roulette.
So this is happening. Now, when these properties are changing hands this way, it's very difficult to have those properties impact property values in any market because they're not contiguous properties, so they're not all in one location.
So what Wanda means is it wasn't like you bought that many houses in one city. These were all over the country.
Right.
So here's the problem. You're an investor and you go buy a bulk sale of homes. Okay, first of all, the goofy part of this was it wasn't really advertised anywhere. What they literally did was they just told all of us, the REO agents, hey, if you have any investors, have them email us at bulksales@fanniemae.com. Mm-hmm. And then we'll send them the information. And then they did sell some packages of homes. And then the people who bought these homes would then either keep them or they would sell some of them. And then what they would do is they would contact agents because we actually had somebody that we know who called us because they were basically told, here's 50 of the houses, I need you to manage them for me. Mm-hmm. And then 2 of them were in Vegas and he just said, hey, we need to sell these. They were purchased in bulk. We know nothing about them. And they were in some random name in the tax thing. And they were super low end too. They were like under $100,000. I think they were $60,000 or whatever. So we went and put them on the MLS and sold them and everything. But it was just, they were this package, they were in Detroit, they were all over the place. Mm-hmm. They were all different. There were some $1 million houses, but they were in like other parts of the country, like maybe in Florida or someplace like that.
Right.
This still had $1 million houses.
Right. But to my point, what's happening now is these institutional investors, they're going ahead and they are packaging them, like Todd said, that they're packaging these houses and they are selling them off to other institutional investors. These houses are not hitting the market, so they're not impacting property values. And so when you're doing that, when you're selling 17 houses, but these houses are all over the country, even if they were hitting the MLS, they probably wouldn't impact values anyway because there aren't enough of them in a particular location to impact the MLS. But they're not even doing that because they're not even showing up. We're
gonna go over the numbers and we're gonna do a whole video on this because this is really fascinating. But back to the original part of the video here is this number is going to increase. Mm-hmm. So remember, it was below 30% when and then the market crash actually helped. Because the cheap properties were so cheap, people could buy it with cash very easily.
Well, the other reason why people were buying them with cash during the real estate crash was because properties were under the threshold of what lenders would loan up for a mortgage. Because the threshold was $60,000. So if you were buying a property, it was $55,000. You couldn't get a loan on it, so you had to buy it cash.
We actually, surprisingly, we had a lender in the office who was renting space from us, who actually came in one day and said, I just went through all your listings and a quarter of them I can't do loans on because they're under the like 60,000, and that's the loan limit. That's not the purchase limit. So they couldn't do a loan. Like lenders would not do loans under 60,000. The reason they wouldn't do it, it's sort of like a real estate agent saying, I won't take a listing if it's not like 100,000 because the commission wasn't enough. The bottom line was they wouldn't, the banks wouldn't do the money because the lenders all got together and said, hey, look, it's not worth our money to go through underwriting and this whole process and pay the loan officers and stuff, and we're only going to package a really small loan. They wouldn't do it. So you pretty much you had to buy cash if these low end properties had to buy cash. And when I say low end property, we're talking a $50,000, $60,000 property. that now is probably could be easily worth over 200,000. Easily worth it. It could be 4x what it was.
Right.
But this number is going to increase. My prediction is it'll be 50% by 2030. That means half of all houses in the U.S. will be owned free and clear. That provides tremendous support to the housing market. Tremendous support. The other thing I predict that's going to happen is we went from 7 years of ownership or before people sold the house. We're at 10 now. I think that's going to go up to about 12 to 13. I think it's going to, because the more people own houses free and clear, they don't want to sell them. Then they want to keep them as rentals, investment properties. It's going to be, and then you have this part of the market locked up, and you have this other part of the market that's that's being sold and other people can buy, and it's just going to push prices up. I think. I mean, that's really one of the reasons I don't think the market's going to crash is because you people looking like the people, and I hate talking about this all the time, but it just pisses me off. The people that are predicting the market crash, they're specifically trying to find like anything that supports their position, and then they make a big deal about it. But they've been doing it for years now, and it doesn't make any sense. Like there's really nothing that proves it. Like, oh my God, look at the prices going up. Look, prices going up, and we just showed the chart on the last video. The inventory is not really going up. It's going up. It goes up every year, and it's going to go down again. It's not going up. Even it's not going up that fast.
Right. So for seasonally adjusted inventory is not going up. Is what Todd's saying. So look, we make our discussions about data that we find from independent sources. If you have data for us to consider, please go ahead and put it in the comments, and we'll go ahead and consider it. Let us know what you think. Real estate, I've said it before, is hyper-local, so we do want to know where you are and what's going on in that market. So when you're telling us, I own a house and this is what's going on in my market, well, tell us where that market is, because that's really helpful for us to get a better understanding. If you like the video, please subscribe, hit the notification bell, share the video, and we'll see you on the next video.
Yep.
Bye.
Bye.